y'all, happy Sunday. So today's video is about the Thrift Savings Plans funds. I know it's not the most exciting stuff, but your future self will thank you when you don't have to go back to work in your 70s because you didn't maximize your contributions early on. I will be pulling most of the information I have from the seventh edition, seeing here, seventh edition of the Thrift Savings Plan Investor's Handbook for federal employees, which the Fed Week publishes. It's an independent company. And then also from the TSP website, which I've shown in previous videos and will also have linked below. Starting off with the C Fund, it's the Common Stock Fund. This fund is invested in a way that duplicates the performance of the S&P 500, which is a stock market index that tracks the performance of the 500 largest companies listed on stock exchanges in the United States. Your gains are based on a few things like capital gains, dividends, interest, and a few more things. I'll dive into more of those terms in future videos. The S Fund is a small cap fund that tracks the Wilshire 4500, which are stocks they're just not big enough to be in the S&P 500. The I Fund is the International Stock Index Investment Fund and tracks the Morgan Stanley, Capital International Europe, Australasia, and Far East Stock Exchange. I know, it's quite the mouthful. Basically, this fund is invested into companies in 21 different countries, with larger percentages of the fund being invested in Japan, the United Kingdom, France, Switzerland, and Germany. The F Fund is the Fixed Income Investment Fund and is designed to invest and track the Bloomberg U.S. Aggregate Bond Index. A bond is like loaning a company or the government money, think like war bonds from history class, and then getting a return. More on bonds in future video. The G Fund is the Government Securities Fund. Investments in this fund are invested into short-term, non-marketable Treasury securities, specifically designed for the TSP. A Treasury security is basically a debt given to fund the government for like spending and stuff like that, and it's considered very safe because the government guarantees that interest and principal payments will be made on time. Also more on treasuries in a future video. Last but not least are the life cycle funds. These funds are broken up into the 5 aforementioned funds and automatically change their holdings over time to accommodate for a lower risk tolerance as you get older. Now, the question you're probably asking yourself is, John, which fund should I invest in? In case you're curious, I'll get to mine in a minute. Dave Ramsey recommends investing 80% to the C Fund, 10% to the S Fund, and 10% to the I Fund. I personally do 90% in the C Fund, 5% in the S Fund, and 5% in the G Fund. Over the last 10 years, the C Fund has averaged a 12.99% annual return. The S Fund has averaged an annual return of 9.34%. The I Fund has averaged an annual return of 5.55%. The F Fund has averaged an annual return of 1.64%. And the G Fund has averaged an annual return of 2.49%. Now, I'm not going to tell you how to invest. I'm not licensed in securities, so I legally can't do that. You should talk with your spouse, someone you trust, or a financial advisor to determine your risk tolerance. With all that said, if I was to make a recommendation, I would recommend investing as much as you can into the C Fund as you could afford to lose because there's still risk. It's still stock investing because the C Fund has the best returns compared to all the companies. I mean, it's not even close. The S Fund is about 3% less than the C Fund, but let me frame it like this. Let's say you're a bank and you have a customer who could have a mortgage with a 6% or 9% interest rate. Which one would you want them to have? The 9%, right? A bank, like any other business, is trying to make money too. Likewise, you need to treat your finances like a business would do its own, and that's maximizing your returns. Some final notes, and then I'll close this out for the day. First, all the TSP investments are made with BlackRock, which is it's an investment company. So the TSP is not the one that actually invests your money. 2, there's a new option to invest in mutual funds with your TSP. I don't know too much about this one just yet, but I'll cover them in a future video. And 3, the last one I have, last tip for today, is that the convenience of a life cycle fund is that it automatically changes what you invest in over time. You put in, for example, let's say you're going to retire in 2075. You'll put your money into the 2075 life cycle fund. And at the beginning, it may be more invested in something like the C Fund. But as you go over time, it'll decrease that investment and increase your investment in things like the G Fund. Uh, if you don't do a life cycle fund, then you have to go in yourself to change your fund allocation. So that's just something to keep in mind. I hope you learned something today, and I hope you look at your TSP account this week just to see what you're invested in. Be sure to like, share, and subscribe for more great financial content, and I'll see y'all in the next video.